All right, give a big round of applause for David Blumberg. David.
Thank you. Oh, I probably need that? No, I don't need that. No need for two microphones. Greetings, everybody. Everyone revved up to become great entrepreneurs and build great companies? One more time. Much better. Okay, tremendous. It's an honor and a privilege to talk to entrepreneurs. We at Blumberg Capital feel that you drive the Ferrari and we're the pit crew. That's our metaphor. We're not your masters. We're not the musketeers or the marionette masters who pull your strings. That's the wrong model for venture capital and entrepreneurs to work together. We think you have the great ideas. You do the really hard work. You stay up eating pizza and beer on the weekends, etc. And we're there to give you resources. First is money, and then it's help recruiting, it's help finding customers, it's help with strategy, all that stuff. That's our model. Today, our topic is unicorns, because everybody talks about unicorns. But first, to talk about anything seriously, we need to define it, put it in context, and then try to figure out what does it really mean, and how can you benefit from it. So that's our goal. And the first question is, do you have what it takes? Well, you're all in the room, so the first part of what it takes is showing up, and you've done that. Let's move right in. So I will move it. How do I need to point this to anything? There we go. How rare are unicorns? First, the definition. Unicorn is a recently defined term. It means basically a company that's still private and worth $1 billion. Now, in history of the world, that is very rare. It's much easier to do now than ever before, but it is still relatively rare. But there are factors that have caused it to be both easier to grow a company faster than ever before, and I'll talk about those, and they've caused people to not go public. There's sort of the push and there's the pull, or different forces. So let's talk about the numbers. In terms of numbers of unicorns, there are approximately now about 163 worldwide. Now, remember, when they go public, they're no longer a unicorn, or if they fall below the $1 billion mark, they're no longer a unicorn. There were 80 that reached that status in 2015, so probably the peak of a market. And part of that had to do with valuations. Valuations in 2014-15 were really on the rise, and we've seen a retrenchment of that since then. So maybe some of those are no longer, but that's what caused such a huge pop in 2015. But again, there are these other two forces. First, what are the negative forces? I'm trying to remember if I need to advance the slide now. I'm going to stay back here. One of the forces that is causing people to stay private longer is Sarbanes-Oxley. This is a bill that was named for two senators in the aftermath of the Enron crisis, back a decade ago at least. And they were trying to root out, Congress's idea was to try and root out corruption in financial accounting of large firms that were going public and hurting the public with pensioners owning the stock and so on. Now, there's a benefit for regulation, but there's also a cost. The cost was that every company had to engage in a lot more accounting and legal rigmarole and red tape and process that was very costly. So that it costs, I've been told, about $3 million to prepare yourself to go public just for the Sarbanes-Oxley part of it alone. There's other costs. But if you're making 10 million net EBITDA, and then 3 million of that leaves your pockets because you have to pay it for these regulations, and then you're going public, you've lost maybe 30% of your market cap. So it's a very big pain for the private investors and the entrepreneurs like you, which aspire to grow great companies. So people have been staying private longer. That's one reason. Another reason is there's been a decline in buy-side research on Wall Street. When I was a young analyst out of college at T. Rowe Price, we had a lot of us analyzing pre-IPO companies so that we would know which ones to buy on the IPO. And that we were assisted by huge numbers of sell-side analysts. And we paid them in what's called soft dollars. We would trade commissions with, say, Goldman Sachs or First Manhattan or different firms at the time. They would give us access to their research analysts for free in trade for us trading through them and buying our shares. A lot of that's gone away for, again, some government reasons and some structural reasons in Wall Street. That's another reason. A third reason is tort litigation. A lot of firms that went public in, say, the 2000 internet boom didn't probably really justify going public. They didn't have a lot of revenue. They were being hyped up a lot, and they fell dramatically. And it led to a lot of lawsuits on behalf of shareholders who felt that they'd been deceived. So that caused a huge amount of risk and liability for people who now go public because they say, if our stock falls, we're at risk of being sued as board members, as investors, as entrepreneurs, et cetera. So it's another factor that caused people to say, wait a minute, maybe we don't want to go public so soon. Let's be steadier. So those are at least 3 reasons, and I'm probably forgetting another one. But there are a number of these factors that have caused a whole set of entrepreneurs to say, let's wait. Now, why, on the other hand, is it easier to grow a unicorn now? Well, I think most of you know that. The reduction in CapEx, it's become a lot cheaper to start an IT company especially, because you don't have to buy a mainframe and a big telephone exchange system that used to sit in your offices. That's part of it. Also, the growth of the developing countries in terms of their market, moving hundreds of millions of people in the last 30 years from poverty to middle class, where they can access apps, they can even buy smartphones, and be part of this economy. I'll give you an example. We have a company in our portfolio, Hootsuite, which has done phenomenally. They're based in Vancouver, Canada. They do a social media dashboard for marketing, social media management, and they now sell in, I think, 190 countries. It was not easy, or maybe even possible, to sell in 190 countries when you're an 8-year-old company, say 20 years ago. The networks didn't exist, the internet was just beginning, no smartphones, and a lot of poor people in the world couldn't afford to be part of the app economy or social media. So a lot of things are better for you today than they were just 20 years ago because we have this, we stand on the shoulders of giants. We stand on the shoulders of these incredible people who built the internet, smartphones, the social media networks, those things we take for granted, and cloud infrastructure. So that's why it's much easier. Another big thing about the difference between then and now, and why it's easier to build companies fast, they become unicorns, is the SaaS model and freemium models of selling versus the old enterprise model. That model was much more linear in its growth patterns. We see a lot of non-linear growth patterns in SaaS and channel sales that Blumberg Capital tends to invest in mostly. I think you understand this, so I want to not belabor it. But those are the factors, again, keeping companies private, we reviewed first, structural, regulatory, allowing you to grow faster, and that's what allows us to have a lot more unicorns than ever in history. And they're semi-rare, but let's do the statistics. Now, we've talked about this, that it's the best time ever in the history of the world to be an entrepreneur. And people say, oh, but there's a recession coming, David, and it's scary, and there's geopolitical crises all over the world, and a lot of danger, and interest rates may rise, and China might fall apart, and Russia's invading, and the Middle East is falling apart. A lot of problems. But we are, first of all, in somewhat of a bubble. Silicon Valley and productivity of high tech seems pretty strong for the future because it's really bringing stuff that is much faster, much cheaper, and much better to the market. That's a safety. If you're selling a commodity like oil, we've seen what can happen when supply-demand changes dramatically. But if you can bring something that's fundamentally better to the market, you can cut through even bad business cycles. And that's what we're seeing, I think, right now. That's why I think this cycle for Silicon Valley will be very different than the 2000 bubble crash, when it was really wildly inflated valuations that came crashing down to earth. Remember that in March of 2000, the NASDAQ reached a peak multiple priced earnings of 175. Today it's about, what, 17, 18, 19, something like that. So it's way different. We're falling out of maybe a second-story building instead of out of a 30-story building, as we did in 2000 timeframe. So very different conditions. Rise of efficient distribution channels, we've talked about that. Social media, smartphones, et cetera. Make your life a lot easier. You can reach a lot more people across the country, across the world. We've talked about a growth of emerging markets. Now, access to education. This is where you're participating today in something that didn't exist very much 20 years ago. Entrepreneurs talking to entrepreneurs and investors, understanding what it takes for you to succeed. We want you to succeed. Even if we don't invest in you, we have a vested interest in wanting you to succeed. There's a very big karma effect in Silicon Valley, and if we give out and help you, you're going to do better, and it builds the whole ecosystem. It's a very positive cycle, and it's different from other industries where it's very much zero-sum. I don't think Silicon Valley is very much zero-sum. It's very much synergistic, 1 and 1 equals 3. Now, the access to education, formal and informal, you're taking advantage of it right now, but as you also know, you can go home tonight and watch YouTube videos of excellent, amazing entrepreneurs who have struggled through incredible difficulties and persevered. We want you to take advantage of that, and now people in a rural village in India can also have that same education. It wasn't possible 20 years ago. Next, angel investors. How many angel investors in the room? Few? Okay. Mostly, how many entrepreneurs in the room? All of you. Awesome. Okay, well, the angels are super important, and we at Blumberg Capital respect them greatly. There's some VCs who take a different view. I've heard some VCs say to them, they don't deserve the title angel. They should just be called individual investors to kind of somehow diminish their worthiness. I say, of course they're angels. They're taking a risk on you. They don't do much diligence. They're trusting you because they know you as a great entrepreneur, as a great person, great character, great fortitude, great persistence. That's a good thing. And thank goodness we have a lot of great entrepreneur angels in the Valley. But that movement is spreading. I'm seeing great groups of entrepreneur angels in Tel Aviv, in Berlin, in Hamburg, other places around the world, London, et cetera, et cetera. And that's a good thing because you know them best and you know them first. Generally, VCs hear about deals second. Angels come first. We at Blumberg Capital like to work with angels together. And we're not going to kick them out of the way and say, we need the whole deal. We're taking 100% of this, get out of the way. We say, no, wait a minute. We'll structure it. We're a professional firm. We're 24/7. We have 9 investment professionals, 3 countries. We've invested in many countries and dozens of companies over the years, have $500 million under management. So that doesn't match most angels. But they bring their value too. Angels bring great value in their specific domain expertise, in their patience and understanding and time they can spend with entrepreneurs. It's a good synergy again. And then last is large corporations. This is also somewhat new. There have been cycles. Corporations go through love with venture capital and startups, and then they fall out of love, and then they go back and forth. I think this relationship is going to be enduring. And here's why. Product cycles have shortened dramatically. As they've shortened, the big companies realize they need more access to innovation. And where does innovation happen? Does it happen generally in the big labs of giant companies with thousands of processes and rules and bureaucrats? No. They generally happen from people like you, a group of 2 or 3 founders, create something new, strike out, have incredible equity incentive, get risk-taking investors like us to follow them, and that's where most of the innovation in the last years has happened, from startups. And then they get acquired or they go public themselves. So the big companies increasingly come to us, Blumberg Capital, and to many of the great venture firms around as filters. We find you. Our firm sees about 3,000 or 4,000 business plans a year. We probably meet with 600 or 700 companies. We might invest in 15 at the end of the day. But large firms, a Samsung, a Ford, all these big ones, they come to us and they say, tell us what you got. What have you seen lately in Internet of Things? What are you seeing in artificial intelligence? What's the latest thing in insurance that we need to know about as a big insurance company who happens to be one of our investors? It's a great thing for you, because if they're interested in you and we can be a facilitator and give you credibility and get you in the door faster, you can get a proof of concept, you can get a beta site, you can get early customers. That's how it works, and it's working well. All right, now, what does it take to pitch an entrepreneur, to pitch a VC firm or an angel? Here's a simple 6 T's that I learned from Neil Weintraut, a distinguished VC himself years ago. I may have changed some of his terminology. First, tell us the theme. What is it that you're pitching? And be crisp, articulate, and brief. Tell us in 1 or 2 sentences the big problem you're solving. Okay? Second is the team. Who's going to do it? It's you. Don't fake it. Don't pad the resumes. If you have a B player right now, temporary, it's okay. Say, here are 3 A players, and we're going to look to improve this one. Mr. VC, Ms. VC, can you help us with that problem? Yes, that's our job. We have a huge network. We know a lot of people who can help build and add to your team. Next is terrain. What is the market? Are you early to market and you have to do a lot of education, channel building? Are you late to the market and it's a commodity and you got to really work on pricing and market fit and all that stuff? That's important. And know your terrain, know your market, and know that you don't just exist in the competition of Silicon Valley. There are a lot of smart people in India, Israel, China, Japan, England, France, looking to compete as well. So get the global terrain map, not just Silicon Valley map. And tell us, please be honest, and tell us why you're better, where you may have weaknesses, and how you're going to address those. Integrity and honesty and transparency are so crucial to you getting our money and to having a good relationship after that. Never compromise on those. And when you talk about your risks and the terrain and the market, it's one of our clearest indications of how honest and transparent and persistent you are. If you've scoped out all of your competition and you really know where you stand, to the best you can, and you have plans to deal with it, that's a big sign to us that you know what it takes to win. Second is technology. Fourth is technology. And notice it's not first. So if you're engineers, and most of you are, Don't only lead with, oh, our technology is the best because it's built on this architecture, blah, 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 blah. First, you have to start with the theme. Why is it solving an important customer problem? And then the following down, and who's going to do it, et cetera, and what's the market. Then you get to the technology. How does it work? Why is it differentiated? Why is it superior? What are its costs, benefits, et cetera, et cetera? Okay. Then and it doesn't have to be just pure technology. If you're in a consumer thing and you have some great brand who's allied with you, if you have an incredible domain expertise, all that can be in the realm of your value-add proprietary IP, let's say. Then there's traction. Now, traction, essentially, we who invest mostly in seed and A rounds often invest in companies with no traction, at least no revenue. Sometimes you've built a product and you come to us and we say, that looks really good. And we have a CIO council. We test it out. We say, if they built this, Mr. CIO of IBM, Ms. CIO of Hewlett-Packard, would you buy this kind of enterprise software? And often we'll get a yes, medium, or no. If we get enough yeses, we say, wow, that's great, we invest. So traction can be validations before you actually have monetization. But of course, if you have monetization, if you have users, that's wonderful. So show that. And that will also be, again, are you early to market or late? And explain your strategy in either of those cases. And then finally, the terms. How much money do you need? What other important aspects do you want a board member? Are you need advisory boards? Other stuff that are important to you, and we negotiate on that. So those are the sort of 6 points you should get across crisply in maybe 20 pages of a presentation that you send to us, which is the easiest way to connect with us. Now, all these unicorns have different paths. Not everything is going to go on the same path. On this same path. One is that you raise a lot of money kind of all up front. That's not easy to do for most people. That is probably a path that is done by a serial entrepreneur, somebody who's already famous, already had a success, and they can raise a lot of money up front. Other folks is to try and get the traction first and try and show and demonstrate, bootstrap it for a while. That A has an advantage of giving you more equity for a longer period of time down the road, so less dilution to you. And it makes it easier for us to eventually make that decision because, yes, you've already proven by your own efforts, by your own bootstrapping of customers, that you have what it takes. And we don't have to do those if they build it, would they buy it, because you've already established that and demonstrated it. So I would say today, in the environment we're in right now, compared to a year ago or 2 years ago, it was a little bit the vision thing. Let's see where they're going and the big story. Today, it's more investors are from Missouri. Show me. Show me what you've got. Show me what you've done. Prove it to me. Demonstrate it. Validate it. That's more where the mood is today, I think, in the investor community. And then there's the third path, and that's the path that most of you will follow. That is like a Mayan. I just came back from Cancun and Chichen Itza. The Mayan pyramids are stair-step pyramids. They're not like the Egyptian pyramids that are like smooth. The Mayan pyramids have stages. That's generally the path you're going to follow. And this path means that you have to build toward a milestone. So the first amount of money is to get you probably product and into the market. Initial testing. This A round is probably to get you real product market fit. The B round is to get you growth. The C round is acceleration. D round is on your way to public. Something like that. And it varies. But that's the basic idea. So these 3 paths. Get a lot of money, generally not available to most of you up front. Second one, bootstrap. Not the path chosen by most, but it's a great path if you can do it. And the third path, which most of you follow, is stair-steps, financing per milestone. One of the things that I think people have gotten really wrong lately, and that's because some of the unicorn myth, is they think that they have to have the highest valuation at the very beginning of their company. And that's just not going to be realistic in a cycle like we are now. When you're in Missouri cycle, it doesn't work. You have to move at pace. Now, what's the reality check? The reality check is that we're in this tight environment that we've just talked about. So check yourself out and don't look in the mirror and say, oh, everything's great. It's going to be tough in the next couple of months. How do we survive? Well, there are a few things. One, we've talked about getting the capital first, some, not all of it, at realistic pricing. Get traction, demonstrate it as best you can. Get ahead of the issues. If you start to see a downturn coming, like right now, you got to watch out and figure out what to do, because otherwise, if you don't get ahead of it and get the money, you're going to have to get out, probably sell the company. Okay, that's not a disaster. Life is very long. You're going to all live to 100, and you can do multiple companies. So if you don't get the money or the traction and get ahead of the downturn, you're going to probably have to sell out, probably earlier than you would have liked to. So last bit is, and I'm just running out of time, I'm going to put all these on here and see if I can have time for this. The odds of raising venture capital are over 100 to 1. It's very hard. 400,000 companies are started every year, 4,500 get financed in total, not just startups, and 15 million to 1 on winning the lottery. So you have a better chance of raising venture capital, even doing a unicorn. Reach for the stars, but make sure that your feet are firmly on the ground. Make sure that you are being realistic all the time. And be passionate about it and build a great company. The rewards will follow. So don't try for the rewards first. Try for the great company, and the benefits come later. It's like a good marriage. Okay, thank you so much. Enjoy. Carpe diem.